Hello, everyone. Good morning. Good morning. As you all are coming in to the Zoom, please make sure that your mics are muted. And if you want to, please make sure that your name or the name of your business is visible. This Zoom is being recorded. Also, please make sure that if you have any questions or comments, that you are using the Q&A feature on the Zoom, not the chat. Please utilize the Q&A feature. Thank you. Okay. All right. Good morning, everybody. Thank you so much for joining us. My name is Alexis Fox. I'm the Marketing and Training Manager here at the South Florida SBDC at FIU. And today we have a really great webinar for you about some financial resources, as well as just overall small business financing, things that you need to know. It's going to be led by our facilitator, Mr. Ray. He is one of our really great Access Capital consultants. He's very experienced. You'll hear a little bit more about him as we go through today's presentation, and then you'll hear directly from him for the duration. Okay, and as I said, we are with South Florida's SBDC here at FIU, and we are a consulting service that is here to assist small businesses in any way that we can. We also provide different resources, such as the webinar that you are attending now, and we're just going to show a quick video that has a little more information about what we do. So as you can see, we do a lot of different things with our consulting efforts, as well as consulting across different areas that would be beneficial to your business. Another really great resource that we have is our newsletter. This is where you can find out about all of the different events that are going on. If you are already a client of ours, you can see information about other clients. You can also see your success stories featured here, as well as different resources and upcoming events and partnerships. So one partnership that we want to discuss today is our partnership with Verizon and their small business digital ready platform. This program is for entrepreneurs who have digital platforms, so a website or some sort of online presence to help grow and scale your business. This is a free platform. All you have to do is register with an email address and password, and you'll have access to personalized learning, one-on-one coaching, peer networking, and different incentives with these courses that they offer. The benefit of the platform is that it's self-paced. So you enroll and you do it at your own time, and you can pick from different topics such as finance, digital marketing, and it's all taught by experts in the field. These workshops are also expert-led, so you can, if you prefer more of a Q&A style learning environment, you can sit in on a Q&A session, or you can join online and live events about the different topics. Another great incentive is their $10,000 grant. Annually, they roll out several different grant opportunities for $10,000 that's allocated to small businesses that engage on their platform. This is what the platform looks like. These are what the resources are. As you can see, none of them are more than an hour long. So it really is a platform that's built with you as an entrepreneur in mind to make the most of your time. As I mentioned, they do have a grant option, and their grant cycle is actually open right now. So you'll be able to apply for the grant as long as you register for the platform. If you have already registered for the platform in the past, you can still apply for the grant. You can apply as many times as you would like throughout the experience, as long as you apply within the deadline, which is December 10th of this year. So by December 10th, you'll need to meet the requirement and submit the application. The application is due by 11:59 p.m. Pacific time on December 10th. So once you've completed the required combination of courses or virtual events, you'll get access to their grant page. It's usually 2 resources that you need to do, and then you'll get access. Now, if you do the 2 resources and you do not receive the grant application portal, you can email Verizon directly at digitalready@verizon.com. Applications again do not roll over, but you must submit a new application for each grant cycle, and you can do as many applications as you'd like, as long as you meet the unique aspects and application requirements, okay? These are some examples of the grant eligible courses. So if you take 2 of these, you should get access to the grant. And if you're interested in signing up for this opportunity, again, it is a $10,000 grant. You will not have to pay it back. It is only 50 awardees in this cycle, so please do it as quickly as you can. It is a lottery service of sorts, so the sooner you get in the drop, the more likely you are to be able to be eligible for the grant. You can sign up using the link in our chat, or you can scan the QR code and get access to the platform as well. Okay. And now that we've talked a little bit about financing, grants are a form of financing, right, Ray?
Absolutely.
Absolutely. I'm going to turn it over to Ray, but I want to introduce him formally first to you all. He is one of our consultants, and he's also a program manager here at FIU. And he specialized in access to capital for small and medium-sized businesses in the South Florida area, and is currently the lead Florida SBDC Access to Capital Task Force at our state level, and also a committee member at the national level. So he knows what he's talking about. He has extensive experience in banking. He spent over 4 decades of his career as a banker and generated close to $1 billion in loans and diversified spectrum loan types throughout Latin America and the Caribbean as well. And he is a college adjunct professor, corporate trainer, and has taught about banking and financing courses for quite some time, which is hard to believe because he's so young. And combination of senior
Oh,
executive experience.
only my hairstylist knows.
Right. He has a unique combination of seasoned executive experience plus seasoned academia. So he knows how to teach this stuff. And you all are in for a real treat. And with that, I'm going to go ahead and turn it over to Ray.
Thank you very much. Okay, so it's good to talk about the purpose of our journey because our journey is critical when it comes down to running a business and understanding that you need to embrace the numbers, the financial aspect of your business. You need to understand it because you need to learn to speak the language of the lenders. So it is, we emphasize this time in and time out, and we have, quite a few presentations with regard to the area of finance because it's so critical. Because at the end of the day, you can't grow the business without any funding. So funding is a critical aspect of your business. So why don't we go to the next slide? And again, financial challenges. Some of the challenges that companies face. Some of them are organizational challenges, issues in hiring, issues in going the route of the electronic route and being able to have the right website, etc. But everything goes close circle into the area of funding. So yeah, let's go to the next. I guess some stats there. Large percentage of small businesses they fail first 7 years, and again due to what? Lack of well-designed plan, lack of capital, which is obviously a big problem. If you can only run so far on friend families and your own funding. But you need to obviously create historicals and be very in tune with what's required by lenders to be able to communicate with them the right and to project the right information that they need. So to run a business, you should have a knowledge of financial statements, and need to learn about the operating cycle of your business to be able to improve its level of profitability. So let's go on to the next slide. Oh, okay. So I always like to do this, and allow me to engage you kind of slide where I try to see to get a feel from everyone if someone can mention what are the three key financial statements in a business. Uh, Anyone? Are we getting anything, Andresa? I guess not. Well, basically, obviously, you have the balance sheet, the income statement, and the flow of fund statements, which we'll talk about it. And then when we talk about where we find the operating cycle, you see we have something on the Q&A here. Yeah, balance sheet, very good. Yeah, balance sheet is definitely one of them. Yeah, balance sheet. What does a balance sheet tell you? It tells you what you own, what you owe, and how much skin in the game you have in the business, which is capital, right? And um, and the operating cycle, which is something that we'll talk about, which is important, is really you'll find that in your balance sheet. Basically, your level of being able to purchase, whether it be inventory, and being able to determine when you need to pay it and when you get paid by the clients. Obviously, if your lag time is too long getting paid with the clients, your profitability is somewhat limited. It's just like, when you're in the real estate business, if you're buying and selling, let's say, the fixer-uppers, if you invest the money and you only turn the sale once a year, then obviously that's the percentage that you get. The more turn that you have, the greater the profitability that you will receive. And and where can I find your capacity to repay a loan? The income statement, right? The profit and loss. Remember, profit and loss and income statement are one of the same, which is the statement that projects the revenues less expenses and then the net profit. So financial management is critical, and that's why financial literacy is something that we push a lot on, and we provide you a lot of support in that regard. And those of us in access to capital, we walk, this through with you, and explain what the lenders are looking for so you can better prepare. And then obviously with the right financial literacy, I think you can expect better performances in sales growth and profitability of the business. Let's go to the next slide. Next, there you go. So there you go. Challenges of understanding what. So we have what first cash flow, and that's what pays the bills, guys. Remember, cash is king. You have to have the cash flow, because that's what's going to be available to debt. You can be selling a lot, but if you're selling on credit and not getting paid, you're not going to see much in the cash flow area. So, cash flow is critical. That's why this operational efficiency is how efficient your cash conversion cycle is. How quickly you can turn the buying of the inventory, the obviously paying back of that, the sale of the inventory, and when you get paid by your clients is obviously critical. The shorter that cycle is, the more profitability you will experience. So, and that profitability and leverage, meaning the way you manage your debt, that's what becomes appealing to lenders. Okay, and that's what makes you more bankable. Next slide. So this particular presentation is one that I created to kind of be like a preface to several other courses that deal, and we'll see as we move into the slides, you'll see exactly what they are. But the idea with these workshops, again, is to eliminate lack of knowledge and then provide functional and fundamental financial literacy for all of you. The more you know about that, the better. Making sure that, because sometimes people say, "Oh, I'm selling, Ray, I'm selling, and I paid my taxes, but when I look at my bank account, I have very little liquidity." And then I say, well, you're probably selling too much on credit, or you're buying too much inventory, or both. And that dries up. When your liquidity dries up, it starts creating problems for you. So that's why, again, this operational cycle that we talk about is so critical. Next slide. So navigating through the challenges of understanding the numbers, financial literacy is at the top of the game. Next slide. So the program topics that we've covered, and today it'll be Small Business Finance 101, but we also go deeply into the understanding of financial statements, budgeting, forecasting, managing your cash flow, and then finally, my favorite is how you bring it all together, how to make it bankable. So let's go into the overview. Next slide. So understanding the basics of small business and what we learn and how you can apply it to your business. Next slide. So we'll see. We get down to the nitty gritty. Okay, so here we are. So when we look at financial statements, when I alluded to that question in that first slide, and I said, what are the key financial statements? There you see them: the balance sheet, the income statement, and the cash flow statement. And then I'll go into each one. And then, analyzing these financial statements, what banks will do is they'll do trend analysis, and which includes, something called common sizing statements, which we'll talk about. And then they'll also do ratio analysis. Again, remember, banks are in the business to lend money, charge an interest, and get paid back, right? The old projected image of the banker being this guy with a long mustache and a top hat and looking very evil and sinister that wants to take away your collateral. In reality, there's a lot of nightmare stories in 2008 where we had the financial crisis, and a lot of banks, when they started to foreclose on properties and stuff, it was a nightmare. And many times they wouldn't get uh, paid back the total amount of the loan when they tried to liquidate it, right? So, and then understanding your financial profile, right? Again, this is all key. All of this, what does it do? It actually prepares you. It prepares you to increase your level of success with the lenders. At the end of the day, the numbers have to be there. But if you understand better what needs to be done, then obviously you're going to be successful. Next slide. So a little bit more, direct about these financial statements. In the case of the income statement, we know that what this income statement reflects are revenues, typically top line revenue, less expenses. Then you get bottom line revenue as a profit, the net income. Okay. Now that demonstrates just how much or how little the company is doing in profitability. And obviously, if you're not a profitable company, you're going to have difficulty in securing a loan. The balance sheet, it tells us what we own, which are assets, what we owe, which are liabilities, and then the difference is owner's equity or capital, which is the skin in the game. For example, if I started a business with $1,000 and I had no debt at the time, I would have assets for $1,000 and capital for 1,000. But as I start moving the business and buying inventory, that's when I start building a base of liabilities, also a base of additional assets. And then, the difference is always reflected in owner's equity, all right? Now, the statement of cash flows, this is actually a lot of people don't realize this is a statement that was created back in the late 80s, and it was a product of a lot of leverage buyouts that were going on. And what it does, it basically tells you where is the cash in the business in three areas: in the operating area, investing area, and financing area, right? So in the operating area, you'll see everything that has to do with the buying of inventory and then getting your net income, and that'll tell you where the inflows and outflows have come in. Then on the investing side, if you buy an asset, obviously it's an outflow of cash. If you sell an asset, it's an inflow of cash. So everything is depicted in outflows and inflows in the cash flow statement. And then the financing, if, for example, you get a loan, that's an inflow. If you pay off a loan, it's an outflow. So there it shows the bank or the analyst exactly where the cash is in the business. So let's face it, if you got two companies with both $5 million in cash, but one of them you got $5 million as a result of a loan, and the other one just simply had built it up through profit and has it, sitting in the checking account. The profile of these companies are totally different, right? One is more leveraged or more indebted than the other. Let's look at the next slide. Okay. So here's the trend analysis that I talked about. And what it is just a kind of a comparative. Common sizing is like when you take your income statement and then on the very top in sales, you put in parentheses 100%. And every line item thereafter under, and this is again in the income statement, is a percentage of sales. And that really does, it basically allows the analyst to see what are the trends in your business and what kind of percentages you are utilizing from your sales in different categories. And it says a lot. It's like a storybook, and this is something as business owners that you should be doing. You should be looking up common sizing statements, and you should do that with your P&L next time, and do the exercise and compare from year to year. Sometimes you'll notice you made more money the following year, but you may have a difficulty with margins deteriorating, and that is kind of a red flag. And these differences or variances, what happens with that, these are typically the ammunition that the analyst use to ask questions, right? So it's good to be in tune with that. And that is, again, comparative financial statements, comparing one statement to the other. Then banks use a lot of ratio analysis, to determine your liquidity, to determine your level of indebtedness. You have the current ratio, the asset ratio, the debt ratio, and basically it is a way of comparing your company to other companies in the industry to see whether or not you are a high performing company or mediocre or actually low performing. And they'll do that ratio analysis in comparison, or let's say with the assistance of benchmarking, right? Which is actually looking at other companies in the industry and comparing how well you're doing. Next slide. So budgeting and forecasting is another item that we emphasize in our training. Understanding the differences between the two, projecting into the future and plotting the process. Typically, when you do SBA lending, that's probably one of the few times that you're you're able to secure a loan based on projections, right? Because typically a lot of companies probably are encountering this problem where they want to do let's say an acquisition and stuff, acquisition loan, for example, and then they discover that if there's no real estate involved, the bank will kind of shy away from it. We do have banks that that currently will do, these are SBA preferred lenders. And, fortunately, these are individuals and these are banks that have, been tried and true and that have been very dependable. That's what we use at the center. I've had many times clients that have difficulty with their own bank, and I say, listen, when you have a bank where you keep a lot of your deposits and they're not lending you any money, I think you need to change banks, right? And that's what I always say. And having been a banker for so many years, I can be frank and honest with you, right? Okay, so budgeting and forecasting, making sure you understand and that it's a tool and that this is something, the more proficient you are in it, the better you're going to fare with your lenders. Next slide. Okay. Managing cash flow, very, very important. We stress that a lot with our classes. Understanding the operating cycle, like I told you, the more you understand how what kind of strategies can you use? Let's say, for example, when you're purchasing inventory, perhaps you can negotiate better terms that the creditors will give you a longer period of time to pay. When that happens, that means that you don't have to pay them. It gives you the chance to get paid first by your clients that you have in your receivables because your receivables are credit sales, right? And then obviously it allows you to reinvest more in the business. So understanding that cash conversion cycle is something that I really stress always to a lot of our clients to understand that and to try to be as proficient in that area as possible. All it can do is provide you with more success with banks. That way, identifying these opportunities for improvement, understanding there's a difference between net income and cash flow. Remember what I said, you could have had bottom line income, but you paid your taxes. But remember, in accrual accounting, you report your sales without actually being actually paid. You have receivables. And so, but as far as accrual accounting is concerned, you've had a sale. So there's a net income involved. Then creating strategies for improving profitability is again, if you understand these issues with your cash conversion cycle, and you do that proficiently, that is definitely going to help you improve your profitability. Next slide. How to make your business bankable is one of our favorites, at least mine, and this is what we do with that particular presentation is helping you to understand what it is. It's almost like allowing you to look through the banker's eyes to be able to see, what they're looking for, understanding, the quantitative aspects of underwriting, what they're looking for, and understanding the 5 C's of credit, which is a platform that's used by, all the lenders, which is, character, capacity, collateral, condition, and capital. And every conceivable lender uses that platform. So understanding how that works is very critical. There's no substitute for someone who is prepared, right? I always say dreamers dream and planners make dreams come true. And that's so true. If you walk into a bank and you have it all together and you're soliciting a loan, obviously it's a lot easier than someone coming in and saying, well, how much are you willing to give me? That shows, poor planning. You're just trying to get money one way or another. So all these things are discussed and covered in that particular course of, how to be bankable. Next slide. So how do we begin? Next slide. Good question. Recommendations for startups. This is an area for those of you that are in that category of startups. You go to the next slide. It's a different story. This is a checklist for going into business. Then you can access on your own. Okay. for those of you who are in the startup category. Well, I must say, in this category of startups, what is very critical, and this is something that we can help you with, is the business plan. Remember, the business plan is your blueprint. It is your blueprint for the business. If you're not able to provide a blueprint of where you're headed with the business, you're going to have a lot of difficulty, right? So if you're a good planner and you use the tool wisely, and then you make the appropriate projections that are realistic, and then your chances for securing a loan are a lot better because remember, as a startup, you don't have a history, right? So you have some sort of semblance of, at least, uh, letting us know where you're headed, right? Where you're headed. Next slide. Okay. And here's some more tips before your business launches, website opens, your doors. First step will be to calculate startup expenses, and what is it, brick and mortar, the service, and whatever you're doing online. Next slide. No. So depending on your business category, you start a list of key expenses. You have to anticipate what those expenses are going to be. You need to have a very good grasp of that. Again, I don't want to spend too much time on this slide because clearly what you need to do is focus on a business plan where you plot out exactly, who you are, your experience, your industry, a little bit of data on the industry and what's the competitive environment, and then you get into the nitty gritty with what kind of a loan you're trying to secure, how is it going to be used, and then you need to demonstrate that you have projections that reflect how you're going to create profitability for your company and be able to, with that, be able to repay your loan. Next slide. And again, this is more of a website. By the way, I believe, if I'm not mistaken, you guys have access to this presentation, so you can look at some of these on your own. Okay, next slide. Okay, okay, for businesses bootstrapping, well, bootstrapping is the best way to fund, obviously, because the easiest if you have the money, right? Uh, and then, by saying retain ownership means that remember, when you fund your business, you either do it with debt or equity. And if you do it with let's say venture capitalists or whatever that want more than just lend you the money, but a piece of ownership, when you start doing that, you start diluting the ownership, and and it's not really a good idea to do that kind of early on, unless if it's an industry that is going to really explode, like the tech industry, whatever. There's possibilities there, and then maybe that's a good route to take. It's tough. It's tough to get through these venture capitalists. They see a lot of applications, and they turn down a lot. So a lot different than your traditional route. Okay, next slide. And here are again just a summary of those financing options. Friends and family are fools. I know that I don't like that part when they put fools, right? Mission-based lenders. These are lenders like Bayside and others that they actually have a social component that they feel that they want to help in a specific industry, and what they'll do is and they have their own funding that they provide. Then you have the government agencies, the SBA guarantee, which is that's where mostly these deals kind of hit that route. Why? Because SBA loans provide a guarantee, so it's a form of collateral for the bank. So that's why the bank feels more comfortable because let's face it, if an SBA loan gives you 90% financing, the reality is, and if the bank has a guarantee of 90%, that means the bank's exposure is only 10%, right? So, this is why, SBA loans are attractive. They're very documentary dense, but they're attractive for banks. Then you have, the non-bank entities like finance companies, crowdfunding, angel investors, and venture capitalists. Okay, next slide. So now that I'm in business, what else do I need to know to scale my business? So this is where you do this introspective analysis. And this is why, again, you need to depict that in your business plan. You gotta say and challenge yourself and say, okay, what is my company about? What is the purpose of my company? What am I trying to do? And you need to be able to project that effectively, so third parties can better understand where you're headed. Okay, next slide. So when you do this company assessment, um, you have to look at what your sales revenue and what kind of margins you have. What are your growth plans and asset purchases? What do you need? What assets do you need to purchase, right? Um, what will be the funding needs for that, And by the way, organizational structure, very important. Banks are going to look at your organizational structure. In the case of SBA, there's been some changes. For example, for an SBA loan nowadays, if you're not a U.S. resident or citizen, their latest changes in their standard operating procedure state that they're not allowed to do that. So when you encounter the idea of bringing in some investors to your company, and if they happen to be foreign investors, and if you're bringing them in as shareholders, then obviously you're going to have difficulty going the SBA route. Again, the level of indebtedness and your credit rating, your FICO scores, you need to manage that. Okay. Very important. Next slide. Okay. Next slide. Can we move? Thank you. All right. So understanding your financial statements, right? The margins and profitability, using the right tools that recommended, like the common sizing statements. Understanding your break even, you need to know where that break even's at, and projecting future growth through budgeting and projections is a key item, right? And this is all going to help in your growth planning. Asset acquisition. What do I need to buy? Do I need to buy trucks, equipment? What is it that I need to be able to comply with my projections? What kind of debt restructuring do I need? Again, you remember the short-term funding is more expensive than long-term funding. Sometimes you may have a property that has a lot of equity. Sometimes you're better off getting a refi on that property, and cash out, and be able to extinguish short-term debt. And then that way it becomes long-term debt. It's spread out through a much longer period of time. The monthly payments dropped, and automatically your profitability and margin actually grow. So very, very critical. I've done that many times with clients. Okay, next slide. The funding needs, again, where are you going to get the money? Are you getting the money from an investor, which would be a capital infusion, or you're going the route of debt financing with lenders? Okay, next slide. So you have then equity and debt is really your funding mix. So when we talk about funding needs, when we talk about funding sources, it's either debt or equity. Next slide. Again, short-term debt and long-term debt, you need to understand the characteristics of each. One thing is for certain, look at your credit cards. Short-term debt is more expensive than long-term debt. That's why when people start asking about interest rates, and you can't compare the pricing on a revolving line of credit unless it's a HELOC, a home equity, a line of credit, to to a long-term debt, a term loan. A term loan is amortized loan through a longer period of time, and there's a possibility of the payments being lower. Next slide. So then you have your funding sources. You have the SBA 7A program, which I will call the Swiss Army knife, which is used for many purposes. They love to use it for acquisition or working capital. When it comes to the SBA 504, much larger loans involve real estate and equipment. Then you have business lines of credit that are revolving credits, just like credit cards, that you use. You use it, you pay it off, and you use it again. Then you have the asset-based lenders that will lend you money for equipment. You may be someone that doesn't have yet the credit that you may need, but yet you have some good assets that you can put up as collateral, or you're buying equipment. That equipment in itself is a collateral, and you'll be able to do that with an asset-based lender. And then you have the irregular commercial loans, for companies that will give you a loan or actually a line, and then or they'll use that loan to perhaps acquire some commercial real estate. Okay, next slide. So understanding the underwriting, this is something that I really try to stress. Um, we talked about the 5 C's of credit. I don't think in this slide I have able to go through each and every line item, but I'll give it a try now. Character deals with your ability to manage your credit. We'll see that in your FICO scores. Then the other key issue in character is the experience that you have. It's very tough for you to go ahead and acquire some sort of franchise, and then you have absolutely no experience in the industry. The lenders will see that as a weakness. All right. So character is about your experience and the way you manage credit. Capacity is your ability to repay. That's when they look at all the trend analysis, common sizing statements, and whatever, and your operating ratios. Then you have collateral. That is, if you have collateral in the transaction, it increases the comfort level with the lender. But I always say collateral does not make a bad loan good, just a good loan better, right? You still have to be performing, right? And then you again the benchmarking we talked about, comparing to industry standards. Next slide, please. Okay. Organizational structure. This is very important here in South Florida for people to understand. Again, is you're U.S. based or non-U.S. based? It makes it very difficult. I had a transaction that I did recently for a client, and they had received in the past SBA loan. They wanted to do an SBA loan again, but the problem is that they sold 85% of their shares to a company in abroad in Colombia, for example, and it was a big paper mill company and stuff. So they were solid, but it immediately disqualified them from the SBA loan. So what I was able to do to help them start getting credit on a standalone basis and depend less on the majority shareholder, I was able to get them a revolving line of credit of $400,000. So that was a good win. But again, the origin of the structure is very, very critical, and the percentage ownership too. Sometimes you could have investors, and it may be, let's say, the shares are fragmented. That means there's a lot of people that own a piece of the pie, but you're always, going to have, let's say, a majority where they're going to look at the majority, and they're going to look at the stand. By the way, if you go forward, yeah, let me see, where are we? Yeah, right there. So basically, here, if you try to secure a loan, right, and you have this fragmented ownership, if anyone, if there's an investor, let's say that qualifies under SBA with the origin, right? But if they own 20% or more, automatically they have to guarantee the loan. Okay. So that's why percentage of ownership is so important. Because let's say if they own less than that 19%, then obviously they do not have to guarantee. The company will guarantee it, and then the lender will look at the majority owner for any additional guarantees. Okay? Next slide. So leverage, very important. Leverage is just another name for debt, right? Obviously, the lower the debt, the higher your credit worthiness. You know that with your credit cards, right? If you have way too much credit card debt, obviously your FICO scores are going to suffer. That's something to consider. That's why you need to manage your credit in a way where you're getting the right level of FICO scores, no less than 680, better to be 700 plus. But I mean, you got to pay attention to that because that will automatically impact the pricing on financing and the accessibility of financing. Next slide. So we as lenders, when we talk about a financial strength, is really a company. If I was to look at the balance sheet, it would be a company that has a good capital base, that's well capitalized. If it's not well capitalized, there's less capital in the capital ratio, then automatically means that it has more debt. If it has more debt under a difficult environment, it's going to be obviously going to create problems. So if you have low to moderate debt level, and then you have consistent core revenues, your company will be considered a company that is well capitalized and has a good financial strength. And obviously, it makes it easier to be bankable. Next slide. The operating efficiency, we've been through this, and again, this is a good slide to show you that you with the cash you buy the materials and services, you create an accounts payable, you have to pay that back. If you have sales, you sell on credit, you create an accounts receivable, and when you get paid in the accounts receivable, you get the cash. So, as you can understand now, the closer that that circle, the shorter the period for that circle, the more profitability you will receive. Next slide. The operating cycle versus conversion cycle. It's about the cash flow, cash conversion. When you pay for inventory and when clients pay, and then the time from purchasing inventory to client payment. Again, managing the dynamics in that is critical to make sure you have sufficient cash flow to be able to continue to buy additional inventory and to demonstrate a good level of profitability. Next slide. Okay, so cash conversion cycle for small businesses are predicated on three central factors: the number of days it takes customers to pay what they owe, the number of days it takes the business to make its product or complete the service, and then the number of days the product or service sits in inventory before it's sold. Next slide. So lenders are looking for what? Efficacy, efficiency in the process. And this is part of your financial management. This is one of the areas that we try very hard to help you with, to strengthen that financial management criteria enables you to better manage your operating cycle and thus your profitability in the company. Next slide. So what to look for? They're going to look at inventory turn, what's your the speed of payments on your accounts payable, and the same in accounts receivable. By the way, in accounts receivable, notice we have bullet points: terms, past dues, and concentration. And the reason why that's there is simply that if you were to approach a bank to try to secure, let's say, receivable financing, which would be financing, guaranteeing the loan with your receivables, what they will do is they'll look at your receivables. They want to see the term. If it's anything over 60 days, they will automatically not do it. If you have past dues, it has to be carved out if you have delinquencies. And then if you happen to have a concentration where, let's say, a large percentage of the receivables is really owned by one client, that's considered a concentration risk because if they bow out or if they simply stop paying you, it's going to put your knickers in a twist, right? In terms of the company's profitability. Next slide. So operating cycle versus cash flow, increase cash flow and profitability by doing what? Shortening the operating cycle. So very, very keen, very important to look at that cash conversion cycle in your business. Next slide. Debt management, right? Debt management and credit rating. Lenders will always weigh your level of indebtedness as a risk factor. I think it's logical, right? If you have way too much debt, then clearly, it's going to be a problem. Why? Well, if you have too much debt, that means you don't have enough, perhaps enough liquidity to take on an additional loan. So that's why they're going to look at what's called debt service coverage ratio, which is how much do you have in net operating income to be able to take on existing debt, continue with it, along with new debt. So debt is a funding source, and its size and mix will definitely impact the approval process. That is so true. And then your FICO scores. Remember, FICO scores are just a moment in time. The quickest way to increase your FICO score is to lower the balances on your revolving credits and making sure that if you're at 30% utilization, you should be in good shape. So you have to manage that. And then I certainly hope and I recommend strongly a lot of you go out and sign up with these different bureaus and being able to access your accounts and look at the ratings and manage that situation. Critical. Next slide. So monitoring your credit scores, there's business credit. You have some sources there, business credit, Dun and Bradstreet, the Paydex score, Experience, and Telescore Plus, and then SBA has its own score. And being able to understand where you're at, it's going to tell you whether you have a high level of opportunity to increase profitability. Go ahead, next slide. Factors of bankability, very important. Debt service coverage, the DSCR, very important. If you have a debt service coverage ratio of 125, which is, how do you calculate it? If I would create a fraction out of it, the numerator would be net operating income without any, let's say, the additional debt, and then you have the total debt. That tells me if you have a 125 or above, that is usually the ticket to success there. Okay, I would call it a ticket to admission, basically. If you have a low debt service coverage ratio, then it's not going to work. Remember, you're using the existing debt plus new debt, right? So credit score, very important. And then obviously how much skin in the game you have. You'll have more skin in the game if you are, like I said, a well-capitalized company. Not, then it's a problem. Next slide. Okay, there are some additional resources. I think that we're at what, actually 6 minutes away. Next slide. Okay. Well, I don't know if Andresa or Alexis, I don't know if we can manage this with them, but if now somebody can provide to me the three key financial statements that you need to understand if you're a business owner, if someone can volunteer. I would love to see some reaction there, huh?
They can write it in the chat, and we also have some questions for you, Ray, as well.
Okay, well let's take the questions. Go right ahead.
So I have a question from Yolanda. She says, if funding needs are related to acquire an existing business, financials must be of the business.
Yeah, okay.
Mhm.
So, good question. When you do, let's say, an acquisition loan, if that's what you're referring to, what the bank will do is they want to, let's say you have an existing business and you just want to expand in the same industry by acquiring another company. What the lender's going to do is going to look at obviously the profitability of the target company, right? And to see, because there needs to be a rationale for this acquisition loan. You're not going to acquire a company that's losing money, right? It's going to be a very difficult challenge to be able to convince a bank to give you financing for a company that's not doing well, right? Typically, the scenarios are people that are retiring, they're exiting the business, and they, basically you want to get out, and so you come in and you buy them out. And then the bank is going to look at your overall global income. They're going to look at the income from your company along with the income of the company that you're targeting, and uh, and that's the way. And again, that scenario is perfect for the SBA 7A that I mentioned to you in previous slides. Okay, we
Thank
have another question, Alexis. Tell
Yes,
me.
we do. This one is from Lance. He says, what factors to determine the type of company you incorporate between a S, C, LLC,
An
etc.
LLC, exactly. Well, I mean, if let's say if you're creating a company, if you have an existing company and you're creating a company, and you want to create a company, let's say to buy the real estate and separate it from the ownership of your company, it's best to do an LLC. Typically, as you grow in let's say in employees, then you start moving, let's say from an LLC. You can start out with an LLC, right? And because you'll be, let's say you may be the only one employed, et cetera. And as you grow with employees, then you may be better off doing a C company, which is because remember what an LLC does, right? It provides what's called, it avoids double taxation, which is a typical scenario with when you have a company, a C company, that you have, if you have, let's say, drawing salaries, right? You're paying taxes on your salary, plus you're paying taxes for the corporation, right? So a lot has to do with the volume and the type of business. If you have an LLC, you avoid the double taxation. It's pass through income, and it's incorporated with your return. Okay, next question.
Yes, we have Lucas answered your question about the three the three factors, the balance sheet, the income statement, and the cash flow statement.
Beautiful. Thank you, Lucas. Good job, buddy. Thank you. Thank you. What else we got?
That is it. Oh, there is one more comment from Lauren. She said, thank you, Ray, for sharing this great information. Joining from my personal coaching business, LG Energy Coaching. Excited to join this community and learn how I can make my business thrive.
Beautiful. Excellent. Well, we're here. We're here to help, and we're very accessible, and we've helped a lot of businesses. About a year ago, I think we were number one in the state and at the national level.
Yeah.
So we've always performed well, and we have a great team, a tremendous administrative team, as well as a great, very knowledgeable team of consultants. Yours truly, with many, many years in the business, and very clear understanding, and with a lot of connections with lenders and stuff. And that's our value added proposition. And so, good luck to you.
We have two more questions. Andrea
Okay.
asks, please repeat the five C's of credit.
Okay. Here we go. The five C's of credit. Remember, character, that's the first one. The next one is capacity. The third one is collateral. The fourth one is condition, and the fifth is capital. So character, remember, it's about what your background and experience, along with the way you manage credit. Capacity is the analyzing quantitatively of the numbers in your business. Then collateral deals with what guarantee, intangible assets are you providing in the transaction. Condition is really refers to the condition of the market that your business is in. It could also be the actual condition of the bank in the sense that the bank may be, let's say, saturated with credits from your industry, so there's no appetite for it, right? Or it may be, I have a lender that sent me a list of businesses that basically they've decided to exit. So those are the five C's of credit, and you can look them up. And trust me, that is the key platform for all lenders. This is how they're going to measure you. They're going to look at you. Okay. All right. Okay. What else we got?
James says, I need a certificate of completion of this course for the NYS SEAP program. Can I send you an email after the webinar? Yes. So,
Okay, that's for you, Alexis.
uh,
Okay. What else we got?
we have,
That was
would you,
good.
yes, from Mariano says, would you suggest to start getting a line of credit first or a term loan for the business?
Okay, well, that's a good question. It depends, Mariano, it depends on what the need is, right? What would you need it for? Could you tell me what you would need the funding for? Is it to buy inventory? Is it to acquire real estate? What is it? Can you answer that or
You would have to type it in the chat, Mariano, if you want to give
type it in the chat there and see if
in the Q&A.
yeah. Yeah, because that remember you got to make sure that the no-no is always to buy a long-term asset with short-term funding. That's a no-no
He
because
said
short-term
yes
funding is a lot more expensive, right?
for inventory. He would like to buy.
Inventory. Well, I mean, you could do you definitely could do a line of credit for for inventory, but I mean a lot of SBA loans, term loans include the acquisition of inventory, and that falls into the category of working capital. So again, but I mean, lines of credit are very flexible. They're more expensive though, right? And sometimes they may be more difficult to secure, right? And it depends on where you go for the line of credit, right? Okay. Whatever you do, please do not go to merchant cash advances. Okay. Those people are putting a lot of businesses out of business, right? In fact, I've come across companies that dealt with PayPal and Shopify or whatever, and found themselves that their loans were really purchase an asset purchase agreement. So that means that they can charge you whatever interest that they want, and they circumvent. I think these people will eventually be regulated, but what they do is, you know, debit your account almost on a weekly basis. They get into your, I've got a client that basically told me that out of the 100,000 that he sells a month, these two companies they take 25%. They automatically take it right out of the checking account. And that doesn't mean, so they're not even considering what expenses you have. So, be careful. Buyer beware.
Okay. Uh, I don't see any more questions in the chat, and we are over time, but I want to thank you so much for all of your insights. This was very insightful. There was a lot of participation, and you all will have access to this presentation via email as well as the recording. So if you prefer to look back at the slides or if you want to listen to the conversation again, you'll have access to both as a result of signing up for today's webinar. All of the links that were shared, all of Ray's resource links will also be available to you via email. And if you found this session valuable, please, we would love to hear your feedback. There's going to be a link in the chat before you go. Please at least copy it into your browser. We need your feedback in order to make sure that we can do more of these. Or if there's subject matters or topics that you feel we're not covering that you would like to see covered, we can do that as well. But we are only able to facilitate your needs if you tell us what you need. So please take the time to do that. Also, if you feel to do so, please leave us a Google review. It helps our searchability and it helps create more impact in the business community for you all. Okay.
Thanks
Okay.
again, guys. We're here to help. We're here to help. This is what we do. And this is one guy that enjoys doing it. So feel free. Okay.
Thank you
All the
all.
best. Take care.
Thank you. All of the links are available to you now. Have a great day.